Hey there, welcome to the show. It's week 28, 2023. We are deep into the month of July, and I either have a cold or the weather outside is affecting my voice, the smoke and whatever. But anyway, I'm going to stumble through this week. I do want to let you know we've got a pretty good show this week. I did a real deep dive into the tipping point of the market. We're going to talk about that. As you can see, the first two slides, as always, are the hot sheet. We're going to jump past those this week because I want to get right to the topic. What is the tipping point for the real estate market? And I think it's a little more involved than just saying, we need the rates to come down. I think we have a lot more involved in that. So let's take a look at some of the different factors that maybe could affect the real estate market. Number one is the job market. And this graphic goes all the way back to pre-1950. And you can see that unemployment, after every recession, unemployment goes up during a recession, and it takes some time for it sometimes to settle back down. The difference is off to the far right here. In fact, let's just bring that in. If you look at from 2019 to present, we had a huge spike when COVID hit. And unemployment really took about 2 full years for it to kind of settle down. We were plugging right along at 3.5% to 4% unemployment rate from 2019 through March of 2020, and then COVID hit, and it spiked to just under 15% nationally. These are national numbers here in April of 2020. And again, it took almost 2 full years to get all the way back down to where we were. And you can see that we're really pretty much back pre-pandemic levels from about March of last year moving forward, even though we had some higher mortgage interest rates in play. At least unemployment is down. I did look at the showing time list of showing activity, and of course that gray line that you see across the top, that's 2020, right after COVID hit. This graphic was created in 2020 after COVID, and therefore it doesn't go back prior to that. But I would say that we've been bumping along a little bit slower pace this year than the last 2 years, and definitely slower than 2020. But really in the last couple of weeks here, it looks like we kind of tailed back together with the last 2 years, except for this last week. Again, it kind of slowed back down again. Another topic we could be looking at here that maybe is affecting the real estate market is the ability for home buyers to have their savings in place. Now, obviously, first-time home buyers, we see a lot of first-time home buyers out there right now that are having trouble struggling to put a large enough down payment down to maybe get them out of the FHA financing, which is really difficult to find a home that'll accept FHA right now, just because there's so many buyers out there that are willing to pay 5, 10, and 20% down or more. But just to give you an idea, back in March of 2023, there were all kinds of articles out there about, Americans' bank accounts were bulging, with the exception of some. But for the most part, with the stimulus money, a lot of people were hanging on to that cash. And then from about February of 2022 till later that summer, people pretty much spent that money. The pandemic savings are basically, there are articles out there saying the savings are evaporating as inflation soars and old activities resume. So as people were getting back out, they were spending that money for, whether it's fun, getaways. A lot of people were putting in pools in that year as well, just trying to figure out how to live at home again. And then fast forward to just this year in May, the same articles are basically out there, just basically talking about the rise and the fall of pandemic excess savings. I think we're back down to what you would consider just probably a typical savings level for most home buyers right now. So we're not seeing any great rises in home savings. So the question really is, again, what is the tipping point for the real estate market? And a lot of people like to say it's the mortgage interest rates. And in fact, I was reached out by Axios this week, reached out to me and was asking me about something called the golden handcuffs, which is basically a way of saying, how many home sellers are basically sitting there at home, locked into staying in their home because they have such a low mortgage interest rate. And my comment to them was basically, I didn't feel like necessarily it was so much mortgage interest rates, but it was more home pricing that was keeping a lot of the inventory and the activity out of the marketplace. So let's kind of look into both of those categories here as we move forward to the end of the show today. We'll start first of all with the mortgage interest rates. I'm going to take a quick drink. And this is the mortgage interest rates from 1971 to present. These are basically from Fannie Mae weekly mortgage interest rates. And you can see that, as of just this past week on July 13th, we were just under 7% at a national rate. And I know that we've seen some local mortgage lenders here already jump above that 7% rate this last week. But nationally, the national rate is currently 6.96% as of July 13th. And if you draw the line across there, you'll see that as far as recently, the most highest rate we've seen was back a year ago in October, where we were at 7.08%. I suspect we're going to probably hit that and surpass that in this next week or two before things start to get better. But the important thing is to look all the way back to March 29th of 2002. That was the last time we were at above 7% interest rates. And that took us almost 20 plus years for us, close to, just 20 years, a little over 20 years to hit that 7%, 7.08% back in October. And I think we're going to surpass that again, like I said, here in a couple of weeks. If interest rates were jumping up, I just don't think interest rates are the big reason. I guess that's my whole point here. I still think it's something different than that. So let's continue and kind of look at what's affecting the rates and how the rates affect the marketplace. Back in February of earlier this year, our low week was 6.09%. That's again from that national mortgage rate survey done by Freddie Mac, 6.09%, and currently at 6.96%. So we're almost a full percent higher from where we were in February of earlier this year. And how that translates to buying power, again, if we use that same analogy of a $1,200 monthly principal and interest payment spread over 30 years, just the principal and interest payment. The purchase power this past week dropped to $181,000, which is our year-to-date low for purchase power versus almost $200,000 back in February when that rate was quite a bit lower. So you can see that the difference of about a full percent has the equivalency of close to $20,000 difference in purchase power. And so, that's, again, you can see that's going to cause people to wait because of the rate, but actually I think it's more along the lines of the home pricing. And so let's dig into that maybe here a little bit. So first of all, we want to look at the number of homes for sale here overall. And for this particular analysis, I'm looking from this year back to 2019. Again, I did a show about a month ago, basically that went over what happened, what would the market be like if COVID never happened. And these graphics kind of come from that data set that I created. And you can see that we are, even though homes for sale are on the rise from the last couple of years, and we're up from the last couple of years, compared to 2019, we are still well below 2019 inventory levels, where we were at almost 4,000 homes for sale. In fact, later in 2019, later in the year, we hit well over 4,000 homes for sale. And I don't think we're going to get anywhere close to that this year, the way things are going. I think we'll hit 3,000 maybe by the end of the year, maybe 3,100, but nowhere close to 4,000. And if you break that down here also by the list price, you can see where the list pricing is this year versus pre-pandemic pricing. And so this is one of the big reasons why I feel like it's not necessarily interest rates, it's more the purchase price. Home buyers, if you remember when interest rates were record low, you still had home buyers out there saying, I'm going to wait for rates to drop. They were going to wait to rates to drop from 3.25% down to 3%, or 4 down to 3.5%. We always had somebody that was out there saying, I'm going to wait for rates to improve. And honestly, what little difference that made in the mortgage interest rates in that particular case, it's so far different when you look at it compared to the list prices here. So this is overall pricing, and again, we're at 375, where we're almost completely $100,000 difference in list prices overall from pre-pandemic levels, and so that's a huge amount. I don't care if interest rates were zero; that's still going to cost you more in a payment just because of that sheer difference in pricing. If we break that down, and the natural thing is try to blame this on new homes. And if you look at this, new home prices are up, and they have been up, but they're not up that dramatically over last year's numbers here. This is the actual count of homes, the homes for sale inventory. They're at one point. Back in May, we were kind of coming even with 2019 inventory, but it started to rise here again just a little bit as we're getting into the fall. Maybe home sales are slowing down just a little bit, and that's pretty natural for this time of year. Back if you look at the median list price, however, we were around 320,000 to 315,000 for new construction back in 2019, and it's 425. So again, it's about that full $100,000 price change there, and that's hard. That's hard for a home buyer to basically purchase, even at 3.5% to 4% interest rates. So if you want to look at the price increase percentage year over year, this is going back to 2019. Really, 2019 to 2020, there was really no change in pricing there. And I don't know if, whether it was just the builders were basically sitting there with their existing inventory and didn't have the price rising yet, only because they probably didn't have the material costs in there like we saw later from the rise of material pricing. But you saw a 15%, almost a 16% increase from 2020 to 21, 11.5% for the next year. And it's slowed down this year. It's only a 6.2% increase over year. But still, that's still a huge difference from where we were just going back to 2019 pre-pandemic levels. How this looks on the existing home market. And, again, we're seeing quite a bit less inventory in the homes for sale inventory levels here for existing homes. We basically are struggling to even hit 1,500 homes on the market, which would have been above our low point in 2019. But we're starting to see the inventory build as it typically does at the end of a year. But again, whether we're going to see the existing homes increase, this is the area where we really need more homes on the market. We could see this inventory could double, and the buyer demand would probably be eating that up, and the whole market would change completely. As far as pricing goes, it's not, it's almost as dramatic. Actually, 250 was a little over $250,000 was a median list price for existing homes back in 2019 during this same period, and it's $350,000 as of today in 2023. So, this is again the main reason why I'm really leaning towards the fact that I think it's more home pricing than it is interest rates. Here's our increase in percentages. Again, 2019 to 2020, we had an 8.6% rise in home pricing. 2020 to 2021, we had a drop of 7.2%, which is predominantly due to a lot of homeowners kind of backing out of the market during the COVID period. And, that uncertainty of what's going to happen, everybody kind of just held tight, and therefore a lot of the homes that were on the market kind of dropped off at least the existing homes dropped off during COVID. And that's why we saw a percentage decrease that year. Then after that, we did see 11.8% the following year and almost a 21% from 2022 to 2023 as of July 16th. So I just can't imagine being a home buyer out there. I mean, I would sell my house. I'm one of those typical people. I would sell my house if I felt like I could get something of equal or better value for the same or less money. Obviously, I'm willing to pay more if I can get something of better value. But right now, I'm having trouble finding homes that would replace this home for a decent price, and that's where I think most people are at that. So, with that said, I really do believe that the tipping point for the real estate market would be more affected by home prices coming down than it would be by mortgage interest rates coming down. I honestly believe that if there was more homes available and they were not as priced outside of what we have seen in the last couple of years, that I think we would see this whole market totally change, and buyer demand would be out there. It would start this whole process of getting a lot of home sellers that are currently sitting off the market, just sitting on the sidelines, waiting for something like this to happen. So I don't know. What are your thoughts? Let me know. Would love to hear your thoughts. Please leave them in the comments below. And if you would like to call me and tell me, or email me, let me know that as well. I'd be happy to get into a conversation with you all. So with that, that's the show this week. I appreciate your time. Apologize for the voice, and we will see you all again next week. Be safe out there.